You have a hard job, Rex.
Thank you, Brandyn.
I just
for
noticed,
recognizing
by the way.
that.
Yeah, it took me a while, but
there's a lot of facets to it between managing the money, doing the planning, managing clients' emotions, and managing, behavioral attributes of clients, like what we're talking about today.
Psychology side is never ending, probably.
Yeah, and I've actually found myself gravitating more and more to that over my career, to where I find the psychology of it significantly more interesting than I did at the beginning of my career.
In behavioral finance, we study many of the subconscious views that investors have towards investing and money. Oftentimes, these views can negatively impact our decisions and ultimately our investment returns. On this episode of Through the Pines, we'll dive into the following behavioral financial concepts: mental accounting, familiarity bias, herd behavior, emotional gap, self-attribution, confirmation bias, recency bias, loss aversion, and anchoring. Welcome to a financial planning podcast with the down-to-earth vibe. Sasquatch listens while brushing his teeth. This is Through the Pines. Our advisor, single, for this episode is Rex Baxter with planwithbaxter.com. We're down a team member, Rex.
We're down a team member. We've got somebody down with the flu.
Which in the middle of summer is a bummer. So, but Rex represents the team of, it's one of the best in the state of Utah, 2023 and 2024, Forbes Best In-State Wealth Management Teams for Utah, Advisor Hub, fastest growing advisors to watch under $1 billion, and the receivers of the Ameriprise Client Experience Award, which means Rex and his team know exactly what they are doing. Again, find Rex at planwithbaxter.com. Let's dive in, Rex, to some of these behavioral financial concepts and how they help us or hurt us when we are trying to amount our fortunes, shall we? So the first one is mental accounting. I don't even know, what is this? Do we like not using a calculator? Like, what is mental accounting?
Mental account. First, thanks for having me on the show. I appreciate it. This one's going to be a little bit different just because it's the first show I think we've done in the last 4 years or so without my partner Brandyn on here. And so shout out to him. Hopefully he gets feeling better soon.
Yeah.
So I think on mental accounting, people are funny as far as they start to account for their money in certain ways mentally. So they used to use the envelope system. You're probably familiar with the envelope system, to where, dad would have 8 envelopes and the utility money goes in this envelope and the house payment goes in the other envelope. And mental accounting is that same thing, to where essentially they may have a savings account saving up for a car, for instance. And that money in their mind, that is my car money. And it's interesting how people act, because all of a sudden they may have a furnace go out, for instance. Mm-hmm. And, I can't touch my car money. That's my car money. Mm-hmm. It's in a savings account. It's right there. Mm-hmm. But no, I'm going to put some money on my home equity line, or I'm going to go put some money on a credit card or something, because I can't touch.
Rather than use cash.
Right. So the most efficient way is to earn interest and not pay interest, right? So if all of a sudden I'm racking up debt with my left hand and I'm earning a little bit of interest on my right, I'm probably losing that game, because the banks never pay you as much interest on your savings as what they charge you on a loan. And so that's why people end up backwards a lot of times and losing the interest game, because their mental accounting is so rigid that they don't have that flexibility that they might need.
I would do that. I think I've done that. I could say I've done that. Because it's a weird, so how do you overcome that, I guess?
Well, I think it's being flexible. And so I like mental accounting in the status of, I have these different buckets to use for things. I'm saving up. I'm saving up for Christmas. I'm saving up for a car. I'm saving up for a house. And I think those are good buckets to be saving into. But then when the whirlwind of life happens and all of a sudden you have some emergency that happens, you've got to be flexible enough to say, okay, instead of racking up debt and that I'm going to pay off over the next year, I'm going to go ahead and I'm going to raid this, and then I'm going to have to resave back into that. Mm-hmm. And that's the most efficient way to utilize your cash and to handle that mental accounting. So I think it's a hang up that it's very natural, and a lot of people get hung up on that.
Mm-hmm. Okay, very good. Familiarity bias. What are we dealing with there?
Well, we all like what we know.
Oh, got you. Yeah.
Right?
I'm familiar with this. Okay.
Yeah, and so familiarity bias is essentially, a lot of times the easiest way to describe it is when you're working for a company and that company may have a public stock, right? And so let's say that, and again, not recommending any one stock or anything like that, but let's say that you work for Costco. And so because you work at Costco, you feel like you know Costco, and you feel like you know whether that's the stock's going up or down and things like that. And so you're just that much more comfortable with that individual company because you're familiar with it. You're familiar with kind of how it's done over the last 5 years while you've worked there, or 10 years. And because you're familiar with it, you build up this false sense of comfort that shouldn't be there. And we all have it. And so you have to be aware enough to take a step back and evaluate yourself and say, okay, is this really a good investment? Is this really a good company from this point forward? Because history doesn't necessarily indicate what's going to happen going forward. Or is this not a good investment from this point forward?
So looking at the hard numbers.
Right.
So because I have heard the advice, and how is familiarity bias different than, say, invest in what you know?
Well, I think invest in what you know is different than familiarity. Familiarity is something that you're intimately involved in.
Okay.
And invest in what you know can be confused with invest with what you think, right? Because all of a sudden, I know McDonald's because I eat there every day. And so or whatever the case may be.
Yeah.
And so it's more of instead of invest in what you know, it's actually invest in what you use. Is what that should have been called, but invest in what you know stuck.
Okay.
Right. And but it's really invest in what you use, right? I use Colgate, toothpaste, therefore I want to buy, Colgate stock, or I use Microsoft computers, or I use Apple computers, and that's what the invest in what you know.
Okay.
Well, do you really know the company and the inner workings and how much debt they have and what their profitability looks like just because you bought a Microsoft computer? Probably not.
Yeah.
And so I think that's another fallacy a little bit that people.
I don't think the people who work there half the time know what's going with the books, like where they're at, because they're busy working on the projects.
Right. Well, and they can't. There's certain things from an insider trading point that the inner circle of the companies have to keep fairly tight-lipped and can't let loose to the masses, or else all of a sudden you get into a lot of legalities with insider trading and things along those lines. And so I feel like how your unit, how your silo is doing, and whether that's profitable or not profitable, and whether you're growing or not growing or flatlining and things along that line. But you may be one silo of 50, right, for that company.
Yeah.
And you may be a large portion of the revenue, or you may not be. And so that comes down to both, the invest in what you use or what you know, in addition to the familiarity of the company itself.
Okay, so we are talking behavioral finance subject here with Rex Baxter, planwithbaxter.com. Herd behavior. This is when, you follow everyone else off a cliff.
This is exactly. My friend jumped, so I should jump, right?
Right.
Isn't that, I think that's taught to us in our teenage years.
Well, I'd say, I was teaching this to my 9-year-old son the other day because he had a friend that decided, because they have a swimming pool, to not put on sunblock, right? Because he's tan, and my son was not tan yet, but because his friend didn't put on sunblock, he didn't want to put on sunblock. I'm like, if he jumped off a cliff, would you jump off? Like, no, you got to put on sunblock. Like, you can't do the same thing as your friend all the time. So yeah, how's it work in the financial arena?
So in the investment arena, the herd mentality that we call out frequently is you invest in what your podmate invests in, right? Is all of a sudden whoever's in the cubicle or the office next to you or whatever the case may be, their 401k is invested in a certain manner.
Yeah.
And they may have had success either by skill or by luck over the last year. And so they sit there and say, oh, you should do this.
Yeah.
But your situation may not be the same as theirs, right? You may have more kids or fewer kids than they have. You may be looking at retiring sooner. You may have additional assets that they don't have or don't know about. You may have fewer assets, and they may have more assets than you don't know about. And so there's so many variables that are involved that I think it's a real danger to sit there and get the herd mentality on investing. Now, the other side of herd mentality is the herd mentality of what's popular. And so we always kind of joke that there's a give me some of that syndrome. And that's the same herd mentality, is whatever has performed phenomenally well. Like over the last year or two, you've had technology, and specifically within technology, you've had artificial intelligence, chip makers do phenomenally well over the last couple of years. And so now that they've done phenomenally well, there's rarely a week that goes by that I don't get the question of, should I own some of that in my portfolio now that it's done fairly well? And the problem is that when you get that herd mentality to where everybody jumps in, it can drive those prices up abnormally high for longer than what anybody thinks, and maybe higher than what anybody thinks. But you have no idea when that's coming down. And when it comes down, those people that invested with a herd mentality, typically they get into another one of the topics that we're going to discuss, but typically they get into emotional investing to where they panic and they sell at the bottom. So they're doing the exact opposite of what theoretically we all know we should be doing, which is buying low and selling high, and they're doing the exact opposite, and they're buying high and then selling low, and then they've had a bad investment experience, and it poisons their next 5, 10, or lifetime of investing.
Yeah, those trends are tough too, because with coin and then with what was the world everyone was building in the internet somewhere, and they were selling real estate in the internet to, what was that world called there for a hot minute?
Well, are you talking about like the CDOs, the collateralized debt obligations from 2008, from that crisis?
Well, it feels like it was a little newer after that. No, it was like where people like the metaverse, or like people were selling.
Oh, you're talking about where they're selling paintings and they're selling.
Yes.
I forget
that
what
was
they call
that was a very trendy. Coin was trendy. That was trendy. And then AI was trendy, but it was actually, there's solid information behind that, and it was a good investment for a while. But like you say, if you're too late if you're at the back of the herd, now what happens?
Well, the perfect example of the herd is the tech bubble of 2000, of 90. It started in the mid 90s.
Yeah.
It ran up through 99, and then it started to pop in 2000, in March of 2000. And essentially during the tech bubble, anything with a .com, right? I mean, you could have, catsathome.com, right? It would be the company, and all of a sudden they'd go public, and there's no earnings. There's just a bunch of kitty litter behind it.
Right.
And all of a sudden that stock just skyrockets.
We all know what's in kitty litter.
Right.
It's not good. Yeah.
So that's what happens, is you get the herd jumping on top of that, driving the stock way up, and then all of a sudden in 2000, over the next 2.5 years, you had the majority of tech companies down 80% or more, and a lot of them go bankrupt during that time period because there was no earnings behind them. There was no true revenue that was going to be profitable, and that's what you're investing in. Again, keep in mind, you are buying companies, and those companies you're owning a piece of, and so you want those companies to generate revenue, but not just revenue. You want them to generate profits. You want them to generate income. And so that's what you're looking for. And if the company doesn't have a path to that, then I'm not sure that you want to own it.
Yeah.
Right.
Okay. Very good. Emotional gap. We start crying on this one. What is an emotional gap when it comes to financial behavior investing?
Yeah, break out the onions.
Okay.
Yeah, people are emotional beings. I mean, they invest based on emotion instead of logic and rational thinking.
And is this sort of with familiarity bias, like similar to it?
It's similar to it, except for you're not investing because you're familiar with it. You're investing based on your emotions. And so, Warren Buffett, one of his famous sayings is, I'm greedy when everybody's fearful, and I'm fearful when everybody's greedy. And that's based on the emotions. Is the masses typically follow their emotions and do the exact wrong thing at the wrong time. And so it's that exact example that I was talking about, to where people want to buy at the top because they're looking in the rearview mirror, and their emotions are, wow, I am missing out, right? I've got FOMO. Right, and I need some of that, because
that's a thing. And how much do you see that in your business?
A lot.
Really?
I see that a lot in my business. And so it's part of the counseling that we have to give to our customers and our clients of, look, let's take a step back from the emotions of it and looking forward, is this a good time to invest? Over the next business cycle, is this a good time to invest?
So what's some, I think I know the answer to this, but in your experience, because this is what you do on the daily, what's more dangerous, the emotional side of I'm missing out on this stock, I need to buy it now, or the emotional side of the market's down, sell everything?
Well, they go hand in hand, right?
Yeah.
And so, but I think the sell everything is much more dangerous than the buy things, because if you buy at the wrong time based on your emotions, as long as it's a good solid company, then you can ride through that business cycle of the downturn, and it should come out the other side if you're just patient. And so I think the most dangerous, if I were to be pinned down, would be on the sell side, is when you cave into those selling emotions. And sometimes there's reasons to sell, right? And sometimes there's reasons to take a loss. And so you just have to be able to break apart the reason as to why you're selling, whether it's emotion or is it logic and rational. Okay,
that makes sense. Self-attribution. Bias? Is it bias or just self-attribution? Period. I don't know what it is.
It's
self-attribution.
Yeah. So it's a bias essentially that you're looking for almost a confirmation. It's kind of like a confirmation bias, to where you're saying, hey, look, I was right last time, and therefore I'm going to be right this time. And so you start confusing skill and luck is the problem. And unfortunately, the markets are not purely scientific.
Does that get into a professional's head sometimes?
Absolutely. All of these things get into professionals' heads
they do. Okay.
as well. Okay. And so I think that if you're the client, you want to have that relationship with your advisor so that you can see if they're self-aware enough to recognize their own their own fallacies in these issues, or whether they're not. Because I see a lot of advisors that get all of these issues. They invest in only the things that they're familiar with, and that may or may not be the right fit. It may get them over concentrated in certain areas. I see advisors sometimes that are emotional beings just like their clients. And so they start jumping on with that herd mentality near the top, and they start jumping off near the bottom, or they've jumped on the top so much that they're always trying to ride through a business cycle.
Yeah.
And then you don't have money to pull from in down markets when you need to. So I see that frequently.
Yeah. And we did a podcast just recently about trends and how the industry has changed in leading into 2024. And you mentioned something about how it used to be where, you'd almost like a stockbroker, you'd have to tell what your people should buy. But that's not a thing anymore, right? Like how is that different from like helping guide a client into buying the right stocks versus you're being told what to sell to a client from your broker, I guess, or something?
So I think there's two different strategies there, or two different, I guess, advisor mentalities there. One is the advisor managing the money? Are they managing the portfolio itself? And so are they doing the stock selection, the buying and selling, or if we outsource that to a third party, a separately managed account, or to mutual fund managers, if we outsourced that buying and selling of individual securities? And that fits the vast majority probably of what most people should be doing. Is most people should be allowing their advisor to guide them towards the overall portfolio and the asset allocation, things like that. However, you do get a certain part of the population that wants to, buy and sell their own securities.
Yeah.
And either they have a passion about it or they're exploring and seeing if they have a passion about it.
Yeah.
And so in those situations, they're trying to run an idea past an advisor and say, hey, look, I've got this idea on ABC stock. This is what I'd like to do. And then they're looking for the advisor to give them guidance. And that's sometimes where you're looking for the affirmation bias of, I want you to support my idea. I don't care if you really like it or not. I just want you to support it because I think I'm right.
Yeah.
And you get in problems where sometimes advisors are just trying to appease you to keep you as a client. And so they're going to tell you yes, without really digging into it to see if it's a good stock or not. So you have to be a little bit careful.
You have a hard job, Rex.
Thank you, Brandyn.
I just
for
noticed,
recognizing
by the way.
that.
Yeah, it took me a while, but
there's a lot of facets to it
Yeah.
between managing the money, doing the planning, managing clients' emotions, and managing, behavioral attributes of clients, like what we're talking about
the
today.
psychology side is never ending, probably.
Yeah, and I've actually found myself gravitating more and more to that over my career, to where I find the psychology of it significantly more interesting than I did at the beginning of my career. But I actually really enjoy studying and understanding the clients and where they're coming from, because it allows me to communicate and to kind of shape that learning to where we get them on a good track and a good trajectory.
Awesome. Again, talking with Rex Baxter, planwithbaxter.com for more information. Confirmation bias.
So that's what I was just referring to is that's confirmation bias. Is you've already got your mind made up. You're just looking for people that will agree with you. And that happens not only in the stock market, it happens in a lot of major decisions in your life. You may be looking at a new job, and you may have already made up your mind, and so now you're going to go talk to those 5 or 6 friends that will agree with you. And avoid the people that will challenge your thought process, is the essence of confirmation bias. And sometimes that happens with jobs. Sometimes that happens with a house. Sometimes that happens with starting up a new business. A lot of times on starting up a new business, that happens. Somebody will have a business idea and want to start up a new business, and they will talk to a number of people, but their communications will gravitate towards only those that are positive, encouraging, and agree with them. Whereas I think if you're astute, you actually want the opposite. You want people to challenge you. You want the naysayers, so that you can look at the issues and say, okay, does that negative issue really have merit, or doesn't it have merit? And then you can weigh those decisions. In the investment world, it's the same thing. Somebody's going to come to us with an investment idea and say, hey, right now, industrial manufacturing real estate is on its ear. I don't think that's done. I think that there's another wave of, the industrial companies that want real estate. And so I think it's a great investment. What do you think? And they want to find advisors that will agree with them and justify putting a lot of money into maybe overweighting that in their portfolio. And I think that that's a danger.
Interesting. Well, all these biases sort of overlap a little bit, I think. So next up is recency bias, which
recency bias has some commonalities.
Yeah.
Right. But it's the fact of a recency bias is I recently had this successful, right? I bought this tech stock and it went up. Therefore, because I had that great positive immediate experience and it was my idea, my next idea is going to be successful too. And so, I'm just that smart, and that's what's going to happen. And that's what recency bias is it's starting to build upon, the most recent success that you've had. And I think each one should have its own weight. Each decision is an independent decision, right? It's kind of like cards, to where every time when you're playing at the blackjack table, or you're playing at the poker table, and all of a sudden somebody flips over a card, it changes the odds for everybody's hands, right? And it's similar to that in the fact that the new decision that you're about to make on a new investment really has nothing to do with your last investment. But your mind is telling you that it does. Your mind is saying that was successful, therefore this one's going to be successful.
That's tough, man. Because as an advisor, how does that work? If you've been successful building portfolios and helping clients invest, does that mess with your head as well?
Absolutely. I think we have to be aware of that as well. I think the one mainstay in building portfolios that's been proven over decades and decades is asset allocation, diversifying your assets across multiple asset classes, across different sectors of the economy, will protect the wealth, and it will grow the wealth over time. And I think that is a fairly strong constant. Whereas I think concentration in anything, and you've heard me say this almost on every podcast, concentration is the number one builder and the number one destroyer of wealth.
Yeah.
And so I think that when we're trying to build a portfolio, we have to keep some of these long-term constants in mind as we're doing it, because the natural feel on a portfolio, and I see this in people's 401k plans all the time, is they don't rebalance the portfolio. And so over the last 4 or 5 years, we've had a very strong market, for instance, and all of a sudden if your normal stock market exposure might be 60% of your portfolio, now it might be 80 or 90, and you're taking significantly more risk than what you were 4 or 5 years ago. And you don't even recognize it because you're not rebalancing it, you're not paying attention. And then when we get into a market downturn, all of a sudden your portfolio is down 2 or 3 times more than what normally you're comfortable with. And then you get into the emotional decision of panicking and selling, and it kind of triggers all of these different events.
How often should a person rebalance their 401k?
There's a lot of studies on that, and I'm not sure that there's a perfect answer to that. I've seen studies that recommend quarterly, semi-annually, and annually. I certainly would say, no less frequently than annually, at least. I personally prefer semi-annually or upon significant market reallocations. And so if you get a major move down or a major move up, then generally that's another good time to go in and rebalance.
Okay. Again, talking with Rex Baxter, planwithbaxter.com. Loss aversion.
So you're afraid of losses.
Yeah, we all are.
Everybody likes to be aggressive when it's going up, and everybody likes to be conservative when it's going down.
No one likes to lose.
Nobody likes to lose.
Yeah.
So I think, loss aversion is that losses are more painful than gains are joyful. So let me say that one more time. Losses are more painful than gains are joyful, right? Just meaning that if your portfolio goes down 10%, you emotionally feel that, significantly more than if your investment portfolio goes up 10%.
Right.
And that starts to create that loss aversion, that I'm afraid of losses. And it's interesting because, in a year like now where the market's up fairly strong over the last 12 or 13 months, we're starting to get people calling and saying, hey, should I be more aggressive now? Because their recent experiences that the market's up and their fear of losses has decreased for the moment temporarily because the market is up. And so now they want to take more risk when, again, technically they maybe should be doing the exact opposite, right? Is either rebalancing and leveling that risk out, or if the market were to get extremely overvalued at some point, maybe reduce your risk and do the opposite.
How much is weighted in timing in the market when, for instance, a newer investor or an investor with a lot of money, I guess, because it could work both ways, decides to put money in the market in a cycle that is either going down or going up. So their first experience, it's going down, and that's not good. But then when it goes up, they're like, okay, they feel better. Or it goes up for a year or two, and then all of a sudden when it goes down, they're like, what's going on?
Yeah.
I haven't lost money yet. Why is it going down? What's worse?
So that's part of that recency bias, right? Is you put the money in, and whatever that first experience is you have in the market, your mind is going to latch onto that. And your mind is going to think that the market is always like that over time. Sorry, that microphone, I got animated. Wow, that microphone got right in my way.
I know.
So I think that you need to, there's a lot of studies about when you have a lump sum or when you have money to invest, should you invest it all at once, or should you dollar cost average, meaning put money in over a time period? And so, for instance, if you put it in over 4 months with a quarter of that money every month for 4 months, and the studies show, and the studies I think are a little bit weighted or biased a little bit, just in the fact that the market goes up more than the market goes down. And so the studies are going to show that you should just invest it when you get it, is what the studies are going to show.
Yeah.
Emotionally, that's highly uncomfortable.
Yeah.
Because everybody wants to be able to time the market, and nobody can time the market, but everybody's going to sit there and second guess themselves and say, is today the day? Was yesterday the day? What day do I invest?
So is the math that the longer you keep it out, the less you can make?
Yeah, the math is the just compounding of interest.
Yeah.
Right? Just that you're not in the market.
Right.
Is the math of it. And so because the market's up more than it's down, the math is get in.
Right.
Right?
That's wild.
And so,
Yeah.
but everybody thinks they're smarter than the market. And so everybody thinks, oh gosh, it's up. I'm going to wait, or I'm going to dollar cost average in, or whatever the case may be. But in reality, nobody knows.
Yeah. And so if you're, I don't know what behavioral that is, where I'm going to dollar cost average because it's the safe thing to do when the numbers suggest it's not.
Yeah. So that's part of the loss aversion.
Loss aversion.
Right?
Okay.
Is you're afraid of the losses more than the gains, more than you are about the gains. And so, but that fear of the losses is keeping you from the long-term gains. Is the reality of it.
All right, last one here on these behavioral finance in investing in money on Through the Pines. Anchoring. What is anchoring?
So anchoring is when you've had a long-term experience with a company. In this case, in investing, anchoring would be, I inherited ABC stock when I was 5, and now I'm 40, and over my lifetime, I've just seen it go up, right? I mean, it's had swings up and down. It's always recovered. It's always gone back up. But because I have this long experience with this one company, then all of a sudden I start to say, thou shalt not ever sell this company, kind of thing, right? Yeah. And it becomes the 27th commandment, whatever number of commandment, right? and so I think that's, you get anchored to this position and you're unwilling to let it go. Now, we also see that when somebody buys a stock and it goes up significantly, then all of a sudden they get tied to it and they're afraid to sell it and take the gain, and they don't want to pay the taxes, and they feel like, my gosh, it's doubled. It'll probably double again, right? And then they look for that confirmation bias and everything else along with it.
I think I have a celebrity example. So I watched Stuart Varney on, I think it's Fox Business, and he openly says that he owns a lot of Microsoft. It's his favorite stock. But he often asks guests on his show, should I sell this? Should I sell this? Because it's his anchor. Like he has owned it forever. And now he's like, what do I do with it now?
Yeah, so I've seen that. I've seen some of those episodes with Stuart as well. And I think you're exactly right. I think one, he's anchored to it. And two, I think he's looking for confirmation of this is a good stock, right? Tell me yes. And very few people want to come on a radio show or come on anything and take a hard position, a hardline position on any one company. One, there's some, regulatory issues with doing that if they own it in their own portfolio, because it can be, you can be pushing the stock, things like that. But in addition to that, when you take a hard position, then you can be graded against that hard position.
Yeah, interesting.
Right?
Yeah.
And nobody wants to be held accountable for a stock position, because in reality, nobody can predict the future. Lots of people think they can, and lots of people confuse recent success with being able to predict the future. But you can't predict the future. You don't know what's going to happen tomorrow.
Yeah.
So,
wow. Thanks, Rex. Anything else we should know on behavioral financial concepts? That was a good roundup of quite a few. I'm sure there's more, but
well, there's a lot. And I think the important thing is to try and be as self-aware as you can about your own emotions and your own investment decisions and how you make them, and then try to work with an advisor that will complement that, or is educated enough in behavioral finance to where they can help root out where those thoughts and feelings are coming from to help you make the best decision possible.
Why don't you go ahead and pitch yourself, planwithbaxter.com. Why should people give you a call, Rex?
They should give us a call if they're looking for good financial planning advice and good investment advice, then give us a call. We'll take care of you.
I love it. If you found value in this podcast, please consider supporting us at buymeacoffee.com/Banyan Media. Also, you can watch and subscribe to us on YouTube at Through the Pines, like our Facebook page as well. Same name, Pines Podcast. Follow our Instagram at Pines Podcast. This has been Through the Pines, reminding you to use yesterday's dollars to finance tomorrow's dreams.